Welcome to the AM Best presentation on captives, key themes and market outlooks for Southeast Asia for the Asian Captive Conference 2021 run by the Yuan IBFC. And many thanks to Farah and the team for arranging this conference. I'd like to introduce our team. Our team for today is Myles Gould, who's Head of Analytics for Southeast Asia, Australia and New Zealand, Chris Lim, Senior Financial Analyst, and Yuan Tian, also Senior Financial Analyst. The agenda we have for today is covering the captive landscape, the Southeast Asia market segment outlooks, the Southeast Asia reinsurance market, and then we're going to have a Q&A. Now, I've only got 30 minutes for the whole session, so we'll be coming through this at a fair pace, but we welcome your questions. So please post your questions on the chat box, and we'll hope to get to those at the end of the session. So I'll now hand over to Chris. Chris?
Thanks, Scott. Hi, everyone. My name is Chris, and I'm glad to be here to share some insights on the captive landscape in the region. Next. So to start off, let's look at some high-level captive statistics for the region. The chart at the top presents the key captive domiciles in the Asia-Pacific region and include both the number of captives as well as the growth in 2020. The captive growth in Asia-Pacific has been robust, albeit coming off a relatively small base. The number of captives that we see in APAC have grown from 175 in 2019 to 186 captives in 2020, with the growth coming off mainly from Singapore and Labuan IBFC. Inclusive of new registrations and surrenders, Singapore has added a net of 7 captives in 2020, while Labuan IBFC has added 3 captives nets. The new captive formations in 2020 were supported by hardening insurance market conditions, as well as tightening insurance capacity. And this provides risk managers a greater value proposition to use captives to optimize risk retention and narrow coverage gaps. The increase in captive utilization and new formations have come from Australian companies, given hardening market conditions in Australia in recent periods. And in addition, the captive growth in APAC has also been supported by an increasing interest from Asian parented companies, including from China, Japan, South Korea, and Taiwan. Contrasted against the captive growth in other global domiciles, the growth in the APAC region is viewed even more positively. Now, if you look at the bar graph in the bottom right, the number of captives remain broadly flat in North America, which is the largest captive domicile globally. In Bermuda and the Caribbean, as well as Europe, the number of captives showed a net decline in 2020 compared to the year before of 89 and 19 respectively, which equates to approximately 4% and 2%. The decrease in captive count in Bermuda in 2020 was driven by the combination of a number of factors, including M&A activities and closure of redundant activities. Adding to that is also the captive re-domestication to the United States, given regulatory overhang around base erosion and profit shifting, which I'll also touch upon briefly in the next slide. There was also a delay in the pipeline for new captive formations, which have been put on hold. Likewise, some of the factors that apply to the decrease in captive count for Bermuda and the Caribbean are also applicable for Europe as well. But notwithstanding the decline in captive count in these regions, captive utilization as measured by the volume of business written has mainly increased. So finally, if we look at the bottom left of this slide, it shows the proportion of captive count by regions in which, despite the robust growth in 2020, APAC currently still remains small as a proportion of the global total. Next. So in this slide, we'll look at a number of key areas that characterize the developments that we have seen in the captive landscape in recent years. And these key themes will continue to be important consideration moving forwards. The increasing usage of captives for risk management is accompanied by the hard market, has supported a captive market landscape. And one of the key value propositions for owning a captive is that a captive serves an important risk management function for the parents and allows them to navigate the underwriting cycles and maintain ongoing access to their protection needs. Given the hardening market conditions, tightened insurance capacities, and tough insurance renewals, a number of captives have either increased insurance retentions or limits, or expanded into new lines of business as the captive parents look for ways for captives to support their overall risk management strategy. Particularly, the company's use of captive insurance is also growing amidst premium rate increases and insurance capacity constraints. Apart from smoothing market cycles, captives also value add by insuring emerging risks and other risks which are hard to insure. Amidst the market dynamics that I've just spoken about, the market is reporting a wider remit of policies that captives are being utilized for, including in directors and officers insurance, professional indemnity, cyber risk, and contingent business interruption. There is also increasing consideration and usage to include employee benefit risks into captives, which can be relevant for some companies to offer extra policy coverages during the pandemic. And in 2020, a first captive has also been launched to insure cryptocurrency assets as well. Notwithstanding some of these factors, which are supportive to the growth of the captive market, captives worldwide are also finding themselves under increasing regulatory scrutiny amidst changes in the global tax environment. Particularly, captive insurance companies have found themselves receiving attention from tax authorities as the Organization for Economic Cooperation and Development, OECD, seeks to eliminate arrangements which exist purely for tax avoidance. The recent proposal of the global minimum tax by 2023 is likely to have some impact on captive insurers and their choice of domicile, although the actual significance remains an area of development, given that the proposal has not yet been finalized. For owners of captives which do not currently consider tax as a major driver regarding their usage and domicile, these regulatory implications will likely be of lesser significance and relevance. The new rules on a global minimum tax will impact the way that countries develop themselves as attractive captive domiciles. To stay competitive, policy support and regulatory incentives would need to evolve to keep pace with international regulatory frameworks to avoid being classified as promoting tax competition unfairly. Apart from fulfilling compliance requirements, captive domiciles will also have to compete against one another, which necessitates the constant need to upgrade and maintain the relevance of the workforce, facilities, infrastructure, and the ancillary services. Next. I will now cover a high-level overview of the credit ratings approach taken at AM Best. So over here, you'll see that the AM Best credit ratings methodology takes a building block approach to determine the credit ratings of an insurer by assessing the balance sheet strength, operating performance, business profile, enterprise risk management, and lift and drag, and an element of comprehensive adjustment which captures factors beyond the other building blocks. We also have a specialty criteria procedure, the alternative risk transfer ART, which speaks more specifically towards the rating assessment for captives. Next. For the purposes of this presentation, I will speak to some captive-specific considerations in relation to the BCRM. Both quantitative and qualitative factors are incorporated in the assessment of a captive's balance sheet strength and considers the available capital to the company and risk requirements arising from underwriting, investments, reinsurance usage, among others. The BCAR model, the Best Capital Adequacy Ratio model, measures the risk-adjusted capitalization of an insurer and forms an important part of this balance sheet strength assessment. For a captive, unique considerations would typically include considerations of underwriting risk requirements arising from its risk profile, including how the company manages its exposure to large losses. Analysis would be made to the captive's financial flexibility, including any capital maintenance agreement, letter of credit, or other available credit facilities. This would feature more for captives, given the inherent volatility of their operating results. In consideration of operating performance, given the risk profile of a captive, a number of captives tend to exhibit volatility in their operating results. There tend to be periods of very low losses, contrasted with periods of significant losses. And this tends to be a consequence of the limited business and product line diversification that can be common for captives, which limits the quality and diversification of earnings. The business profile assessment takes into account not just a captive's line of business and geographical diversification or concentration, but also any competitive advantages for the captive. Given the mission of the captives, especially single-parent captives, the business profile can be constrained by its product line and certain concentration. Very often, the strategic relationship of the captive within its parent group determines access to business in the absence of a broader market profile. AM Best will also assess the risk management framework and the risk management capability of the captive in relation to its risk profile relative to the parent company's business operations. AM Best views that the captive's approach to ESG is often linked with the parent organization. An increasing number of captive owners have integrated ESG factors in their operations, including areas such as corporate governance and investments. And in the last building block on the right, you'll see that AM Best analysis will also include an assessment of the non-insured ultimate parent as part of the rating lift and drag building block. The evaluation considers the credit profile of the parent and also the level of implicit and explicit support that it provides to the captive. This would include a holistic consideration of the level of integration, strategic importance, and contribution of the captive to the overall enterprise. And next, I will hand it over to Yuan, who will speak to you about the market segment outlooks for the region.
Okay, good afternoon, everyone. My name is Yuan. I'm a senior financial analyst at AM Best Singapore office. So in this part, I want to take you through some market segment outlooks we have for a number of Southeast Asia non-life insurance market. So I want to begin by explaining what we mean in terms of market segment outlook. A market segment outlook covers some key perspective trends we observe for specific markets over the next coming year. We consider those trends in terms of the market condition, economic condition, regulatory environment, and the competitive pressure, emerging product developments, for example. We have three keywords to use to assign to each market. They are positive, negative, and stable. So if a market outlook is assigned as negative, it doesn't mean that the company within that market will have some negative rating action. It is not an indicator of company's rating movement. But what it may mean is that there may be some headwinds or more headwinds that the company is facing in that market, and it captures the market environments for those insurance companies having business there. So it's important for us to look at how the market or how those companies manage those trends and consider those factors. Next slide, please. So due to the time constraint we have today, I may not go into too much detail in each of this market. I just pick up one or two key headwinds or tailwinds to talk about. For more details, underlying reports, also there are some other market segments we cover. Please refer to our company website. Next slide, please. So now let's look at the Malaysian non-life insurance market, which we have a stable outlook. This market has some major regulatory update. There's a phase liberalization for motor and the fire business, which started in 2016. So far, we have observed that most companies in this market have managed this ongoing phase liberalization relatively well. It hasn't caused too much market turbulence. So most of those non-life insurers in the market have good underwriting capability. They have a good underwriting discipline, and the market is well regulated. So all of those help the whole market to go through this transition more smoothly. On the economic side, due to some challenging economic condition, the market has been muted in terms of the growth over recent year. In addition to that, due to the low interest rate environment, we have observed there's a tendency for those companies to allocate investment assets into some higher risk classes, such as unit trust, higher yield corporate bonds, which could drive an increase in volatility on their investment earning. But overall, the market is well capitalized. In addition, and they have a good underwriting discipline, good risk management capability. So we assigned a stable outlook. Next slide, please. So move on to Indonesia. We have a negative outlook for the non-life insurance segment. In addition to the economic challenge, implication of COVID, we have seen there's a significant declining in credit insurance in terms of the profitability. So credit insurance has grown very rapidly over recent years and become one of the key line business in this market. The risk has been heightened during the weaker economic condition. So we have seen a number of companies with a material exposure to this line of business have experienced increased losses during the past year. And then they may subject to further deterioration given the long-term nature of the business. The deterioration is also a reflection of weak underwriting risk management for managing this line of business. Another two lines in this market are motor and the fire. The pricing for those two lines are still tariffed. So those help partially to reduce some unhealthy price competition. The capital adequacy overall is robust for the whole industry. However, there's a weaker economic recovery, heightened market volatility, weak underwriting risk management, as I mentioned. So those together lead to a negative outlook for the Indonesian non-life market. Move on to Philippines. Next slide, please. So move on to Philippine non-life, which we have a stable outlook. In Philippines, catastrophe hazard is a key risk feature, and property insurance is a major line of business. For this line, there's a high competition and a soft market condition. So to manage this, good risk management, diversification by lines and the geography, and also the reinsurance support, they're important for managing the underwriting experience. On the regulatory side, there's increasing minimum regulatory capital requirement, which leads to some market consolidation, and also we expect the trends to continue. But on the longer term, it may strengthen the overall insurance industry capitalization. So we view this to be credit positive for the entire market. Next, please. So on the Vietnam non-life insurance market, we have a stable outlook. This market features strong growth. Even in 2020, during the COVID arising, market shows an overall growth around 6% as comparing to premium decline in most of other non-life insurance market in the region. The second wave of COVID this year have shown more disruption to the economy, but we expect the market expansion is going to continue this year. Health and the PA insurance has been a growth driver, although there's a big acceleration trends observed due to some segments in this line experiencing the lower profits. In general, Vietnam has a sound economic fundamental. There's a large young population, growing middle class. In addition, there's a low insurance penetration rate. Those factors together highlights the growth potential for the overall market. So we assign a stable outlook. Next, please. So I just want to wrap up. So as you can see, there are some similar trends observed in those markets in terms of headwinds and the tailwinds. For example, the weaker economic recovery, uncertainty around the COVID situation, low interest rate environment, high market competition. But in addition to that, we also observed acceleration in digital transformation and innovation. For example, in Malaysia, we saw new product developments, utilization of data for pricing. The data capability has improved. In Indonesia, there are more spending on technology with the rising insurtechs and the partnerships with those insurtechs on policy management, expansion to the new digital channels. In Philippines, e-commerce channel has become a growing distribution channel, especially for the retail lines of business. And in Vietnam, the industry is working together on enhancing the IT infrastructure and building better data capability. And overall, improve the operating efficiency to manage the business. So we will closely monitor those situations and continue to follow up on any developments. So perhaps I just close this part and then hand it over to Myles to take you through some market conditions for the reinsurance market in the region. Over to you, Myles.
Thanks very much, Yuan, and good afternoon, everyone. Thank you for joining this session. So just to wrap up the AM Best panel session, we're going to spend a few minutes just to talk about the reinsurance market dynamics and conditions in the Southeast Asia region. So next slide, please. So let's start by just recapping on the performance of Southeast Asia reinsurers, and hopefully this just sets the scene for some of the opportunities and challenges that we'll come on to in the subsequent slides. So as can be seen in the chart, domestic reinsurers in this region have generally seen unprofitable underwriting results over the last 5 years. And the only exception to this was 2017. 2018 and 2019 in particular were impacted by high incidence of catastrophe events, both in the region, but also globally as well. And in 2020, we did see some improvement, but it was still a moderate level of catastrophe loss experience for this sector. In terms of the COVID-19 impact, Southeast Asia reinsurers generally saw what we would consider to be a negligible to low impact from business interruption and related claims. And this was really supported by exclusions embedded in policy wordings following the prior SARS experience in the region. We haven't seen the same level of disagreement in the market around business interruption as we have in some other parts of the world. It's also noteworthy that the 2020 technical performance that you can see on this chart did benefit from a level of improvement in claims experience seen in the region's primary insurance markets. And this was particularly true for travel, motor, and workers' compensation as a result of pandemic-driven movement restrictions in these countries and markets. So at an overall level, despite seeing some improvement, 2020 technical performance still remained marginally loss-making. And this was reflective of ongoing competitive market conditions and premium rate inadequacies in some areas. And on the investment side, COVID-19 driven economic slowdowns in the region generally resulted in declining interest rates. And although we did see this, there was a level of market volatility that did support some companies actually realizing P&L investment gains, which is what actually accounts for the overall uptick in the investment yields that you can see in 2020 as compared to previous years. But underlying this is very much a story of declining interest rates and yields. So moving on to the next slide, let's take a further look at the investment conditions. And I think what is fair to say is that historically Southeast Asia reinsurers have been able to post pretty good investment returns. And this has gone a long way to counteract those underwriting losses that we touched upon in the first slide. And this has been driven by favorable deposit rates and treasury yields, which in many cases are much higher than we would see in developed markets around the world. However, the economic fallout from COVID-19 has driven interest rates lower, and this environment is expected to continue over the near term. And also, we're immediately seeing with the reference of Omicron, banks around the world, international banks, looking at what the interest rate landscape and inflation environment may be like going forwards. So as summarized in the table here, you can see that base rates in selected Southeast Asian countries have trended down, and in some instances very significantly since the start of the pandemic. And we do view this very much as a headwind to the overall operating results of the reinsurance segment going forwards. So next slide, please. Okay, so just to wrap up, at an overall level, given the aforementioned challenging investment conditions, we do expect Southeast Asian reinsurers to have approached key renewal seasons in 2021, and this is substantiated by what we're hearing in the market as well, very much with a focus on improving technical profitability. However, it is also fair to say that traditional capital continued to support significant capacity in the market, which did go some way to stifle previously anticipated price increases in the 2021 reinsurance renewal periods. Nevertheless, reinsurance participants did manage to achieve, in some cases, quite notable rate hikes on loss-impacted accounts. And the focus on underwriting discipline in these areas also drove robust negotiations on contracts terms and coverages. Having said all of this, I think AM Best is of the view that the reinsurance market in the region did fall a little bit short of achieving true hard market conditions. And the terminology we would use actually is that that the market moved largely to a correction phase, So positive rate momentum, but perhaps a little bit short of overall hard market conditions. The only caveat or exception to this, I would say, is the retrocession market. And in this particular subsegment, we did see much more pronounced price hardening trends in 2021. And this reflects the far more limited capacity that we see in this segment. So looking forward into 2022, reinsurers are expected to remain focused on driving further rate increases, contract term improvements to aid their underlying technical performance. There are also opportunities in this space as well to access alternative capital. By way of example, Singapore has attracted significant bond issuances owing to the regulator's cat bond scheme, which supports an upfront costs to be borne by that program. And we're yet to see some of the regional players really make use of this scheme, but we have seen instances of international reinsurers launching special purpose vehicles using this scheme to access Asia cat risks. So other than these dynamics, reinsurers also have opportunities to diversify and reduce current concentrations, which are often very much focused towards property business. And the primary markets in the region have experienced notable growth in life and health business. And there was strong momentum in this before the pandemic. And obviously the current environment has further increased the awareness for these product areas. And this obviously then flows to, by extension, to presenting opportunities for the reinsurance market as well. So there are a few of the opportunities on the challenges side or headwinds. I think we've touched upon those already, and that's very much the continued competitive market conditions and the low and potentially bumpy investment yield environment that we expect over the near to medium term. So that concludes my remarks today, and what I'll now do is just hand back to Scott to see if we've got any questions for the Q&A section. Thanks very much.
Thanks, Myles. Thanks to the team. Yes, we do have several questions. We've only got a few minutes left, guys, so we need to motor through this fairly quickly. The first question relates to COVID, no surprise, because COVID is amongst us all. The question was, compared to pre-COVID and now with COVID, what are the key differences that you see in the captive market? I think first I'll throw to Myles, and maybe Chris will have a few comments after you, Myles.
Thanks very much, Scott. Yes, and I'll pass over to Chris in a moment, but I think my answer to this question is, it's a bit of a mixed bag, and I would also say that it's probably similar to what we see in the general insurance market as well. So I think for the market as a whole, we saw in the early stages sort of operational challenges introduced by the pandemic, and then very much companies coming on song with operating in that environment. Beyond that, I think it is sort of a case-by-case basis, and what I would say is that for certain lines of business, energy, travel, those sort of areas which were very much impacted by the pandemic, we would expect to see captives that operate heavily in those spaces seeing quite significant volatility in revenues in particular. And obviously in the section I've just spoken about on reinsurance, investment challenges were key, and I think that would very much extend to captives as well. I think in terms of longer term impact for the captive segment, yes, I think there will be consideration of potentially new products or new product coverages that could fit within the captive landscape that emanate from pandemic risks. But Chris, I don't know whether you've got anything further you'd like to add to that.
Absolutely. So in terms of pre-COVID and now with COVID, clearly there are also additional points that I would like to add on. So during COVID, I think it is also pertinent to point out that this period of time also coincides with a period of hardening reinsurance market conditions. There has been an increasing utilization of captives during COVID, and given that despite the pandemic, the addition of new risks from the hardening commercial lines market and the underlying economic growth in some areas have resulted in premium growth during this period of time. So to serve its mission as well, I mean, captives do provide the flexibility to navigate the underwriting cycles, and especially key during the period of COVID, there has been greater consideration to utilize captives to provide coverages where it's in areas where it's harder to find coverages. So there has also been interest to include excluded coverages, such as for vaccines within employee benefit risk within as well. In addition, I think performance-wise, I think what we do see is that the COVID-19 pandemic does not appear to have materially affected the performance. So AM Best also has just released a report that details some of the performance metrics for AM Best rated captives globally. And it shows that despite the pandemic, the operating performance for AM Best rated captives remains strong globally.
Thanks, Chris. We only have a few minutes left, guys, so a quick one for Yuan, please. Another question. Due to the ongoing pandemic situation and uncertainties around that, do you expect to have more negative market outlooks? Yuan.
It's an interesting question. Well, as I mentioned that our market segment outlook that covers some prospective trends in the market over the next 12 months. So those trends are not static. Yes, there are a lot of uncertainties around the developments of pandemics, but we will monitor and then look at how the market, the government responding to those prevailing situation. In addition to that, there are some new emerging trends. For example, the heightened inflation, potential rising interest rates, over the near to medium term. Some of those may be negative, but some might be positive, depending on how the market segment manage that and how the company's business mix and investment mix look like. So what I will say that it doesn't mean that we will have more negative outlook, but we will monitor the trends and then determine how the situation will development over the time.
Thanks, Yuan.
Thank you.
Thank you so much. Okay, last question. That's going to go to Myles. Myles, are you ready? It's an ESG question because ESG always comes up. ESG appears to be a topic receiving increased focus at present. Can you comment on how this is impacting AM Best ratings? Myles.
Yeah, thanks, Scott. And a very topical question at the moment. So I think what I'd say is, the first thing to bear in mind is that from a rating perspective, our primary focus is on understanding where E, S, and G, so environmental, social, and governance factors, or considerations actually drive an impact or a potential impact on the financial strength of a rated entity. And that's true of captives, that's true of insurers, reinsurers, right across the board. And also, ESG is not a new concept to AM Best in many ways, and considerations in these areas have been factored into our ratings, including, for example, sort of governance risks or governance failures or climate risks through CAT exposure, for many years. But what AM Best has done recently is bolstered its methodology, really to specifically address ESG topics. And very recently, actually, in the course of the last week or so, there's been a subtle refinement to our credit reports, which is to include a level of commentary on ESG factors where it's applicable to financial strength. So I think my final remark is, we're very much focused on financial strength. We're not doing ESG hygiene assessments at this point. It is very much a case of how does it impact the rating assessment on a captive or other insurer or reinsurer.
Thanks, Myles. Thank you very much. We're out of time. Thanks to the AM Best team. Thank you to Farah, Roy, and the IBFC team. Sorry, we're a few minutes over, but we had lots of questions. We need to deal with them. And now I hand back to Wymon. Thank you very much.